Good afternoon. My name is Thomas Seneca, founding partner of TM Wealth Management. And thanks for joining us this afternoon, where we'll be discussing the year-end tax strategies that you can employ to get the maximum tax benefits. Quickly, just a little disclosure today for our presentation. This is designed to be educational, right? We're not CPAs, we're not accountants, we're not tax professionals, but we know enough about what our clients are doing and what our CPA partners recommend. We want to share some insights as you prepare for the 2024 tax season. Anything that we talk about today, you should consult with your own tax professionals and learn how it applies to you specifically. Also, you'll see at the end, there's an opportunity if you want to schedule some time with us to talk in a broader sense, not just about taxes, but about financial planning, retirement planning, estate planning, insurance, all the elements that go along with wealth management. We'd be happy to schedule that preliminary consultation. Also today, we've got a number of folks joining us on the webinar, so we won't have time to take live questions, but if something pops in your mind, you do have a question, feel free to stick it in the chat or send us an email. We will respond directly to all of those questions that we get to make sure that you have the information you need to make the best decisions for you. Great. Just a little bit about me for those that we haven't met. I started my career on Wall Street, worked for Goldman Sachs and Deutsche Bank on the investment banking side. And that was very valuable experience. I kind of grew up wanting to be an investment banker, worked in New York, in Manhattan, and also in San Francisco. But I learned two important things from that experience. The first thing I learned is I want to do something that is meaningful and impactful. And you can argue that an IPO or an M&A transaction is meaningful and impactful, but it wasn't the kind of impact that I wanted to have. And so I transitioned from investment banking to wealth management, where I get to sit across the table from families and individuals to help them make the best decisions for them. The other thing that I learned is that I like to do something that is more relationship-based and not so transactional. So in our practice, we like to really dig deep with each individual to better understand their unique needs, desires, and goals, and craft a financial plan to help them achieve those things. A little bit about our firm. So when I transitioned from investment banking, I started TM Wealth Management, and I had a clear design in my mind about the kind of firm that I wanted to create. And the first thing that was important is being independent. We don't have a home office or someone that is directing us in terms of the strategies or products that we need to be employing. So we're independent. We work directly for and with our clients. The second element that was important to me is that we remain somewhat boutique. To me, that means that we have the time and ability to meet with each individual client and go deep with them to understand exactly what their needs are and how we can tailor a strategy to help them achieve the outcomes that they desire. The third thing was wealth management. I didn't want to put blinders on and just look at their investments or retirement accounts. I think there's a lot of elements that go into impacting your financial decisions and the financial outcomes that you want. And so we look at everything. Again, we're not the CPAs and we're not the trust and estate attorneys, but we know enough to be able to direct those professionals to help get the outcomes and the benefits that each one of our clients wants to achieve. And then lastly, it was important that we operate under the regulatory format that was putting our interests and aligning those interests with clients. And that's the fiduciary standard. So that's a legal obligation to do what's in our client's best interest. So we are an SEC registered investment advisor. So that's our commercial. Now let's dig into kind of taxes and some year-end strategies that you can employ to be more tax efficient. And if we go back just a little bit, where it all started, back in 1909, there was a proposed amendment to start taxing the citizens of the United States. And then in 1913, it was ratified by 3/4 of the states. At that time, it was 48 states. And originally, it was proposed as a tax on the rich. In 1913, only 1% of the population paid an income tax, and the rate was 1%. And we've come a long way since then. We now have, this gives us a history of the historical highest marginal income tax rate. And if you look at that graph, a lot of people, taxes is a big bite out of our incomes, and it always feels like a lot. But right now we are in a historically low tax environment, at least through 2025. And so we want to start taking advantage of this historically low tax environment to be as tax efficient as possible and maybe employ some strategies that will allow us to lock in these low tax rates for a certain portion of our accounts and of our income. So just a little reminder of kind of where we are now and where we're going next year, because there's some things we can do this year before the end of the year, before the end of 2024, to be a little more tax efficient. But we also want to be able to look forward to what's going to happen next year and even on into 2026. So right now, if you look at the, just picking one, the 35% tax bracket, one of the things that the current tax policy did is index things for inflation. So when you see these tax brackets, they're going to continue to go up based on an inflation rate. So you see back in, or for this year, the 35% tax bracket for married filing jointly caps out at $731,000. 37% bracket goes to $731,200. Anything above that gets a 37% tax rate. Now for next year, same tax rates, but the brackets are getting a little bit higher, right? So in 2025, the 35% tax bracket caps out at $751,600. So it's important to understand kind of what's happening and the inflation adjustments. The other thing that just to be aware of is that in 2026, if Congress does nothing in this next year, all the tax rates go up because the current tax policy, the current tax rates expire and they sunset back to what the tax rates were prior to this existing policy. And so there's potential that 2026, the tax rates could go up. I think the current president-elect has said that they want to extend the current tax policy. We'll kind of have to see what they're able to get done in this next year and how those policies might get enacted. But some preparation for potential tax rates going up in 2026 is prudent. Also looking at the changes for the standard deduction, right? So this year, married filing jointly, the standard deduction is $29,200. And if you are 65 or older, there's some additional deduction that you can take. And then in 2025, again, remember, things are indexed for inflation. So now the married filing jointly deduction in 2025 is going to be $30,000. So this is an important element to understand for those that may itemize, right? So if you are making charitable contributions or you have a big health expense in one year, right? It might make sense to itemize or bunch those itemizations in any one year to get the maximum tax benefit. Also, capital gains rates. In 2024, really, if you're married filing jointly, the first $100,000 of tax or $94,000 of capital gains is tax-free if that's the only income that you have, right? So if you have W-2 income, Social Security income, then obviously that's going to bump you up into a higher bracket. But really, the 20% tax rate doesn't kick in 2024 until your adjusted gross income is over $583,000. So that's an important element to be aware of. We want to try and keep those capital gains taxed at the lowest rate possible. So when you're starting to do, whether it's Roth conversions or selling things, for capital gains, we want to try and keep you in that 15% capital gains tax rate. Again, index for inflation. So the 2025 rates go up. The first 96,000 is tax-free, 0% capital gains rate, and then the 20% kicks in above $600,000 of income. So keeping some of those things in mind. The last comparison that we want to make is the retirement savings limits. So 2024, most people have a 401k, and if you are under 50, you can put $23,000 into that 401k of your salary deferrals. If you're over 50, you can add another $7,500. So $30,500 is the max that you can put in out of your salary into 401k plan. Also an IRA, right? The maximum limit is $7,000 if you're under 50, $8,000 if you're over 50. 2025 looks like it's going to stay pretty similar for the IRAs, but for 401ks, there's a couple of big changes. The first, not so big change, but a change is the increase in the contribution amount. So now you can put $23,500 into if you're under 50, into your 401k. The catch-up stays the same, but in 2025, they're adding this catch-up limit for age 60 to 63. So you can put an additional $11,250 if you are age 60 through 63 into your 401k plan. So a couple of changes, and there's a couple of other big changes as well coming in 2026 to 401k plans that we'll talk about a little bit more. So now that we've kind of set the table in terms of what are the rates and what's going on, here's some things that we want to kind of highlight, some of these specific strategies that you can employ to be more tax efficient. And that's being do tax efficient charitable giving, maximize your retirement and college savings plan contributions, talk about Roth conversions and contributions, how to be efficient there, take care of tax loss harvesting to, again, maximize your capital gains treatment, and then focus on asset location, like where are the specific investments located in terms of the specific account so we can be a little more tax efficient. Great. So let's first jump into qualified charitable contributions. One of the changes with the Secure Act 2.0 is it changed when required minimum distributions have to start. That went from 70.5 to then 72, and now it's 73. Now, if you were having to do required minimum distributions before the Secure Act, then you stay having to do those. But for new folks that are starting to turn 73, that's when your required minimum distributions they kick in. And these are basically in 401ks and IRAs. The IRS basically says, look, you've deferred, if you've done pre-tax contributions, you've deferred this account and this income long enough. When you hit 73, we're now going to force you to take a certain amount out so that we can now tax it. So there's nothing you can do about that. If it's in an IRA or 401k and you're 73, you have to start making these required minimum distributions. The only change is that if you're still working at 73, you don't have to make those distributions out of a 401k. One of the options that you can make for your required minimum distributions, if you do charitable giving, is you can make a charitable contribution from your IRA directly to the charitable institution and not have that show up as taxable income. So the idea is that, hey, if I'm going to make in this case, this example that we're talking about, a $25,000 charitable donation, it would make more sense to be more tax efficient to do that charitable donation through a qualified charitable distribution rather than just writing a check. So if you look at this example with John and Lisa, ages 70 and 73, they're both having to make required minimum distributions. Their tax picture is they have $40,000 in a pension, $35,000 of Social Security, and they've got a $60,000 required minimum distribution. So their total taxable income is $135,000. Deductions eligible itemized, so they take the $10,000 SALT deduction, they take the $25,000 cash contribution or charitable contribution that they made, or they could take the standard deduction of $27,000. But in this case, it makes more sense for them to itemize, and so then their federal and state tax liability is $18,795. The rate here doesn't matter. I mean, it's just a matter of what the math is in terms of the benefit. So in this case, instead of doing the full 60,000 required minimum distribution, they still have to do a 60,000 distribution, and they're just doing 35,000 to themselves, and then $25,000 to a qualified charitable distribution, so a charity. So what that means is what shows up as taxable income on their return is the 35,000 and not the 25,000 that they've sent directly to the charity. So in this case, when they go to itemize, right, it doesn't make sense for them to itemize because the $25,000 that they gave to the charity doesn't show up anywhere on their tax return. So it doesn't show up as taxable income. So instead of taking the itemized deduction, they will take the standard deduction of $27,000. So that means that now they have a tax liability of $13,462. Right? So that's almost a $5,000 tax efficient benefit by doing a QCD versus just writing a check out of cash to a charitable organization. And we do these at the end of every year with clients that are charitably inclined. And it doesn't need to all be to one client. Sometimes we have clients that send out 30 to 40 checks to different charitable institutions to be able to meet their charitable donation that they want to give, but also satisfy their required minimum distribution. So a way to be a little more tax efficient with your charitable giving. Now, maybe you're not doing required minimum distributions. If you are not there yet, then it might make sense to donate stock instead of cash. right? So if you have stock and the charity can receive what are called donations in kind, it would make sense to donate the stock to them, appreciated stock, rather than writing them a check. So in this example, you've got you're going to give $10,000 to charity. You have some stock that you paid $2,000 for. You've held it longer than 12 months, and now it's worth $10,000. And if you're at the top tax bracket of 37% and 20% long-term capital gains, then here's how it would play out, right? The $10,000 cash, you assume that you're going to be taxed on that because that's income, right? So you paid $3,700 in tax, and then you write a check to the charity for $10,000. If you donate stock, then you get the $10,000, that $3,700, and the $8,000 of gain that just goes away, right? Because what you've done is you've given that stock, that appreciated security, that $8,000 to the charity. And you still get to deduct on your itemized return $10,000 as a charitable contribution. Now, as soon as you gift that, you could take the $10,000 of cash you were going to write to them and go back and buy the exact same stock that you gave them. And so your investment position hasn't changed. But in this specific scenario, you've now avoided $3,700 in tax on that gain that you would have incurred had you sold the stock and then paid the $10,000 to the charitable institution. Again, we do this a lot for clients as well. You can do it throughout the year. Market's up right now. Now would be a good time to maybe take some of those appreciated securities and donate a few of those shares to a charitable organization if you are so inclined. We don't say do this just for the tax benefit. If you are charitably inclined and are doing some charitable contributions anyway, this is just a more tax efficient way to do that. So donating stock. The next thing we want to make sure in terms of strategies is make sure you're maximizing your retirement, college, and HSA contributions, right? So if you look at your statement, right, your 401k or other plan statement, and if you do the math and it looks like you're not going to get to the full limit, in this case, $23,000, and if you're doing a catch-up, $7,500, so $30,500, maybe go in and change your contributions here at the end of the year, right? Say I want some plans will allow you to put 100% of your salary into the 401k every paycheck. Some of them limit it to 75,000. But you may want to look and say, hey, let me increase my contributions here before the end of the year to make sure I'm getting the maximum contribution, and then change it back come January and do the math to make sure you've got a more measured approach of making your 401k or qualified retirement plan contributions in a measured way. So at the end of the year, you're getting the full benefit. The downside to under contributing to these plans, whether it's an IRA, a 401k, 403b, is that once that year has gone, you can't go back and double up, right? You couldn't say, oh, well, I didn't make an IRA contribution in 2023, so this year I'm going to make a $14,000 contribution and catch up. Nope, once that year's gone, the contribution opportunity is gone. And so in terms of retirement savings, we want to take advantage of these vehicles as much as possible so that you can maximize your retirement savings. So just look at your statement, figure out how much you've got that you're going to contribute here through the end of the year. And if you can, from a cash flow standpoint, sustain an increased contribution, we would recommend that you do that, especially if you're doing pre-tax, because that's just going to lower your taxable income if you're maxing out how much you're putting into your 401k or other accounts that are tax advantaged. College savings plans, right? So we want to maximize those. If you are planning for college for kids, it makes sense to make 529 contributions. Changes to 529s have been dramatic over the last couple of years because now you can use those funds for more things. In certain cases, you can use a portion of your 529 for private school, K through 12. You can also use it now for computers and resources for college. And then now in certain circumstances, if you don't use the full balance of a 529, you can now roll it over into a Roth IRA for the benefit of the beneficiary of the 529 or the kids, whoever's the beneficiary on the 529. So they're becoming more of a valuable resource for a number of reasons, both for educational savings, for estate planning, to make sure that you're getting more tax advantaged vehicles in your plan. This just looks at, there's a couple of ways to fund a 529, right? You can just do a certain amount every year and contribute into a 529 as the kids mature and get closer to going to college. Another way to think about it is something that's called super funding a 529, right? And so this looks at if there's two parents with a child, the maximum that you can gift to any one person as an individual each year is $18,000. Now you can gift more, but anything over that would require a gift tax return. Probably no gift tax would be due, but it does require a gift tax return. So what this looks at, it says, well, if you have two parents and a child, that means each parent can give $18,000 each to that one child, right? So over a 5-year period, that would be a significant amount that they can contribute, right? So in this initial scenario, right, if you've annually funded $36,000 for 5 years and had it grow at 8%, you'd get $225,000 at the end of 5 years. If you super fund it, right, and put $180,000 into a 529, and in this case, 2 accounts, and got it invested, same rate of return, you'd have $265,000 in that 529. So an additional $40,000 in the 529 just because you have overfunded or super funded it at the beginning. Now, again, we don't project and recommend or say that you're going to get consistent 8% year growth, but the math case just indicates that the more you can get into these plans, the sooner, the higher the potential benefit that you can get. And you can give these this 5-year super funding without having to fund file a gift tax return, right? It's because it's below the exclusion. Additionally, for Virginia residents, if you fund a Virginia 529 account, you get a $4,000 per account tax deduction, a little over $200 tax benefit for each account, right? And so that's each account per beneficiary. So if you open an account, if you have two parents and they each open an account for the one child, right, that would be 4 accounts. So you would be able to get the tax deduction of $4,000 over 4 accounts. And that would then get your tax benefit closer to, $800 to $900 in a year for that contribution. The other thing is there's no minimum time requirement that the money has to be funded into a 529. Right, so you could open a 529, fund it with whatever amount you're comfortable with, and then immediately take it out and use it to buy whatever educational resources or expenses that you have, and get the Virginia 529 tax deduction. Now you can also ask, well, is that process and that administrative effort worth a $200 Virginia state tax benefit? That's something you have to decide for yourself, but just highlighting that 529s, given some of the changes now, are a great vehicle both for education, for estate planning, and also for retirement planning for the kids, for the beneficiaries, because a portion of the 529s can now be rolled over to a Roth IRA over a period of time for the benefit of the beneficiary. So we want to start looking at these a little bit differently than just an educational funding vehicle. And then lastly, HSA contributions. This becomes almost like a Roth IRA or a tax-free IRA, right? So if you are under the correct health plan, it's got to be a high deductible plan, right? So a minimum health insurance plan deductible for a family of $3,200, maximum out-of-pocket expenses of $16,000 for a family, right? You can contribute to an HSA. For a family, that's $8,300 a year that you can start to put into an HSA that is pre-tax. So it gives you a tax deduction, reduces your taxable income on your tax return. And then you can invest your HSA. And as that money grows, if you use the HSA for medical expenses, then it is tax-free distributions. So what we see clients doing and recommend is fund this for as long as you can, because in retirement, most people have more health expenses than they do when they're young. And now you have a tax-free bucket to meet your income needs in retirement, because you can pull it out for different medical expenses. So want to maximize that as you're looking both to reduce taxes and also increase your tax-free income in the future. Now let's jump to Roth conversions and Roths in general, right? So the benefit to a Roth is that you put money in after tax, right? You've paid the tax, and now it grows tax-free. Some people can't qualify to contribute to a Roth, right? Either their 401k plan or their employer doesn't offer a Roth option, or they make too much money to be able to contribute directly to a Roth IRA, right? So if we look here, if you're married filing jointly and your modified adjusted gross income is over 240,000, then you cannot contribute directly to a Roth IRA, right? So what you can do is if you have a traditional IRA or pre-tax 401k is you can pull the money out, called a Roth conversion, without a penalty, and then you can pay the tax. It'll show up on your tax return, and then deposit that money into a Roth IRA or Roth vehicle. And then that money will continue to grow tax-free, right? So you pay the tax now, you pull all the money out, pay the tax now, put it into a Roth, and it continues to grow tax-free. That's called a Roth conversion. Again, no penalty even if you're below 59.5. But the only downside is that you have to pay the tax in the year that you do the Roth conversion. You also have to be aware that there are no recharacterizations anymore. It used to be that you pull the money out and within 12 months you say, oh, I didn't mean to do that. Let me kind of unwind that. Once you do a Roth conversion nowadays, it is done. You're paying the tax. It's going to show up on your tax return, and you can't unwind it again. And so if we look at the pros and cons, right, you can increase your tax-free savings. If interest rates go or tax rates go up, it's a hedge. There's estate strategy benefits, right? When you inherit a Roth IRA, yes, you have to take the money out within 10 years, but now the money is tax-free because it's a Roth. Versus a traditional IRA that you inherit, yes, you have to take it out over 10 years, but all of that money is going to be taxed at the ordinary income of the recipient, of the beneficiary. The other benefit to Roth is there's no RMDs. When you hit 73, you've got a Roth IRA, you're not now forced by the IRS to take the money out, and there's still no taxes. So one of the things when you're considering a Roth conversion, you've got to understand, what is the time horizon? When do I need these funds? What's the current tax bracket that I'm in? Is it worth doing a Roth conversion and paying the tax now, and then having the benefit of tax-free income in the future, right? And then the other big consideration is, how are you going to pay the tax on the conversion, right? So if you take out $100,000 and do a Roth conversion, and you're in the 37% tax bracket, there's a $37,000 tax bill that's going to be due. Now we want to try and get all of that 100,000 into the Roth IRA or Roth vehicle, so that can now grow tax-free. So if you do that, then you've got to get the 37,000 from somewhere else, savings account, salary, something like that, or you've got to pull it out of the conversion amount. And then at that point, you're only getting $63,000 into a Roth for tax-free growth. So if you can pay the tax from something else other than the conversion amount, then you get more into a Roth vehicle. So let's kind of look at the Roth math, right? So this is a simple example. And if you see here, the example is, here's a traditional IRA and a Roth IRA. Both have $1 million in them. And the current bracket is 25%, right? Just for easy math, right? So the balance in both of these, right? If you assume you have $1 million you put into a traditional IRA, no tax. If you have $1 million and you get taxed at 25% and you put that into a Roth IRA and pay the tax out of this balance, right? You're only gonna have $750,000 growing in that Roth IRA. So that's how we get to the 750. Now we're just assuming, a growth here over that 10-year period of 70%. So that means that the account balance at the end of 10 years in the traditional IRA would be 1.7 million. And the account balance in the Roth IRA would be 1.275 million, right? And then let's say you take all that money out in 1 year because you've got to buy in that second home for whatever reason. And you're still in the same tax bracket at 25% and same tax rate at 25%. So you take the $1,700 out. You pay your $1.7 million out. You pay the $425,000 tax, and you're left with $1.275 million to spend. In the Roth, same scenario, right? 1.275, it grew from 750 to 1.275. You take it all out to buy that second home, you pay no tax, so you have 1.275 to spend. So what this illustrates is that if tax rates stay the same, you are no better and no worse off by doing a Roth conversion, right? If tax rates stay the same and you get the same growth within the portfolio, you're no better or no worse off having done a Roth conversion. Now let's look at what happens if tax rates go up, right? So just watch this 25% down here at the second scenario, and that is the only change that we're making, right? So tax rates go from 25% to 45%. Same scenario up top, right? $1 million into a traditional IRA, no taxes due. Roth IRA, I pull the $1 million out, pay the tax rate at that point in time of 25% to $250,000. So I've got $750,000 growing in my Roth IRA. Same rate of return, 70% growth over that 10-year period. So now in the Roth IRA, I have 1.275 million in my account. I can pull it all out and I can spend 1.275 million. In the traditional IRA, still grew to 1.7 million, but because now tax rates went up, now I have to pay $765,000 when I pull all that money out. And now my balance is only $935,000, right? So an over $300,000 tax difference by doing a Roth conversion than leaving it all in a traditional IRA and taking money out when I need it. Now, again, this is an oversimplification. Rarely would somebody, take all the money out of their traditional IRA in 1 year to kind of bump them into that that highest tax bracket. But it's just illustrative that if tax rates stay the same, you're no better or no worse off by doing a Roth conversion. If tax rates go up, you're better off. And if tax rates go down, then you would be worse off, right? But the overall wisdom and insight is that we expect tax rates to go up just given the amount of spending and the amount of debt that we have as a country. Now, some folks will say, well, when I get into retirement, I'm going to be in a lower tax bracket. That's also something to consider, right? If you think, hey, right now I'm at my peak earning years, doesn't make sense for me to do a Roth conversion now, because when I get into retirement, I won't need as much income and I'll be in a lower bracket. That's something you'll have to evaluate. But the challenge is, even if brackets stay where they are, but rates go up, you might still be paying a higher tax. So just something to evaluate. What we recommend is, rather than doing a large one-time Roth conversion, is that every year you evaluate, what is my income going to be, and let me fill up that bracket, right? So let's say you're in the married filing jointly, you're in the 24% tax bracket, and your taxable income for that year is $300,000. Well, you still have $84,000 almost of income that you could receive and still stay in that 24% tax bracket. So in that year, we do an extra $80,000 Roth conversion to what we call fill up that bracket. So as you get with your tax professional, say, hey, where do you think I'm going to end this year? Then you can say, well, let me fill up that bracket with a Roth conversion. And that's something worth looking at. Just do it every year for a couple of years, and you'll be surprised over time how much money you've been able to convert by still staying within a lower tax bracket. Another thing to consider is, we've got clients that say, look, I am always, just because of the income needs that they have and the income that they generate, they say, hey, I am always going to be in the top rate. And I think the top rate's going up, so I'm going to pay, the 37%, because I think ultimately it's going to be 39 or 40 or something higher. And that's just a conversation you need to have with your tax professionals to be able to decide, is that going to be the most efficient approach for you to do a Roth conversion at that higher tax rate. One other consideration, if you are close to claiming Medicare or are claiming Medicare, when you do a Roth conversion, that shows up as income. And that can affect what's called your income-related monthly adjustment amount. And this is what Medicare charges for those that have more income than over $206,000 in 2024. And so what the IRS does, or what Medicare does, is they go back and look at what was your tax returned income 2 years ago. So for 2024, it's 2022 is what they're going to look at, your 2022 tax return. If your income as a married filing jointly was over $206,000, then they're going to have your plan premium go, or under $206,000 is going to be $174. If you're over and in this range between 206 and 258, now they're going to charge you a difference now, of almost $60 more per month. Right. So that's what you've got to consider if you start doing these things, which are going to increase your income, is be aware what other taxes and what other impacts it might have to your overall tax picture. And the Medicare IRMAA is one of those, because you pay that every month. over the year for not only you, but your spouse potentially. And it's based on your income 2 years from now. So if you're doing a Roth conversion now in 2024, it's going to impact your IRMAA potentially in 2026. You want to run through that analysis. Now, some of you might be saying, well, I don't have enough income to be able to do I've got too much income to be able to do a Roth contribution. So I don't have anything in Roth, so Roth conversions don't apply to me. Well, there's two ways you can get money into a Roth, right? If your 401k plan or company plan has Roth option, you can get money in that way. But there's also a IRA strategy called a backdoor Roth IRA. Now, this is not some crazy Cayman Islands offshore strategy. The IRS is going to catch you and cause more problems for you. This is a very tried and true strategy the IRS is very aware of. But essentially what you would do is anyone can make a contribution to a traditional IRA. Now, depending on your income, it may not be tax deductible, right? So if your income is too high, then you're going to make a after-tax contribution to a traditional IRA, right? So if you call it $8,000 into a Roth IRA and you do not get the tax deduction, that is after-tax money you have now put into the traditional IRA. Shortly thereafter, we usually recommend, even though this is 2 to 3 days, we usually recommend a month. Let it sit there so you get a statement that shows, hey, I made this contribution. Here's how long it was in there. Then you do a Roth conversion, right? You take that $8,000 that you've already paid tax on, and you convert it from a traditional IRA to a Roth IRA. Now, that $8,000 is not taxable in any way when you do the Roth conversion because you already paid the tax because you didn't get a tax deduction over here in step one when you made the contribution to a traditional IRA. So that $8,000 transfers tax-free. So now you have $8,000 in a Roth IRA by doing this two-step process. You will have to fill out Form 8606 when you do your tax return saying, hey, I made this after-tax contribution to a traditional IRA, and then I converted it. And you can do that every single year, right? So you can get, if you're over 50, you can get $8,000 into that Roth IRA every year, even though your income is above the Roth IRA contribution limits. Now, one thing to be aware of is this step 3. There's something called the pro rata rule, which means the IRS basically says if you have multiple traditional IRAs, we look at all of your traditional IRAs as one. So even if you have one at Schwab, you've got one at Fidelity, you've got one at Robinhood, right? You've got these 3 different IRAs and say, hey, I'm just going to convert the IRA that I have at Fidelity. Can't do that, right? The IRS base says, no, all those accounts are one, and maybe only the Fidelity was a after-tax contribution. So they're going to look at that and say, now you've got to do a math calculation to say, okay, if I'm going to convert just the Fidelity, how much of all of my traditional IRAs is after-tax contribution to determine how much of that conversion now is tax-free, right? So there's a bit of a calculation and process to it. So if you have multiple traditional IRAs out there, we want to look at that and make sure we understand what the pro rata rule to understand how much of the conversion now is tax-free. But just another strategy that you can do each year. And if it's you and your spouse, right now you're getting $16,000 a year if you're over 50 into a Roth IRA, even though your income limits may be above that, or if your employer doesn't offer a Roth option within the employer retirement plan. So Roths are a big benefit, and we want to work as hard as we can understanding your tax picture to get as much into Roth IRAs as possible, because that'll help us have a bucket of tax-free income in the future. And if you really want to hedge against where tax rates are going to be in the future, you want to have some money in a taxable account. You want to have some money in a pre-tax account, 401k, traditional IRA. Then you want to have money in a tax-free account, right? So now when we have those 3 buckets, now when we go to pull income when you're in retirement, now we've got some options to optimize the income that you're receiving so that you're not bumping up into different tax brackets or triggering different taxes because everything you're taking out is ordinary income tax. So it's a good way to make sure that your money lasts longer by having money in multiple different types of buckets. The next thing we want to look at is tax loss harvesting, right? So at this time of year, it's unlikely, depending on how you've invested this last year, that you have losses. But maybe you had something you bought a number of years ago that just isn't performing and you want to exit that. We want to realize that loss so we can use it to offset future gains or current gains. So this is an example of Joe and Sue. They bought 100,000 of SPY, and since then it's gone down $30,000. So 30% down. It's now worth $70,000. They go ahead and sell that at $70,000. They realize a $30,000 loss. Immediately, they redeploy that 70,000 and they buy a large cap value fund that now goes from 70,000 to 92,000, right? So now they've gained in this new investment, they now have a capital gain of $22,000. So when we take those two transactions together, they now use that $22,000 of loss, that $30,000 of loss, they can now use to offset the $22,000 of gain, right? So if we look at this in greater detail, right? So they had $22,000 of gain. So the 30,000 offsets that. So that $22,000 capital gain taxed at zero, right? Because they're using some of that 30,000. They can use 3,000 of that 30,000 loss to offset ordinary income, right? Their W-2 income, Social Security income, whatever, right? So you can, the maximum you can use to offset ordinary income of a capital loss is $3,000 every single year. And so they've used now $25,000 of the loss, the $30,000 loss, to offset taxes. And that remaining $5,000, they can carry forward to the next year. So if they have a $5,000 capital gain next year, it will get taxed at zero because they have this $5K that they can carry over each year. So just by doing this simple transaction now, they've reduced their tax liability by $4,200, right? $3,300 of capital gains tax potentially, and $900 of ordinary income tax if they're in the 30% marginal tax bracket. Now, look, we don't want to go and make investments just for losses, but no stock goes straight up. So there's a period of time when maybe you have a loss, and so maybe you exit like they did, right? You exit the SPY and buy something else. You can't buy the same thing, right? You can't sell SPY and then buy SPY. That's called what's called a wash sale. The IRS will look at that and say, look, you bought the exact same thing. You can't just sell this for a loss and then get right back into the same security. So you'd have to get into something else that is substantially different. So the SPY is different than a large cap value fund. So they had a similar type of investment strategy, but they were able to realize this $30,000 loss and get all these potential tax benefits. So it's worth going through your portfolio and say, hey, what do I have losses? What do I have gains? Let me realize these losses. Maybe you've got Home Depot and it's down. Great, sell Home Depot and buy Lowe's, right? Same exposure, home improvement exposure, but now you're realizing a loss that you can use to offset both ordinary income up to $3,000, and then you're also using it for any future or current capital gains that you'll see in future years. So a great strategy. The next thing we want to look at is asset location, right? A lot of people are getting hit by this now because in previous years, we didn't really get much for our savings accounts. We didn't get much for our bond portfolios because interest rates just weren't there. But now we're starting to get a lot more taxable income because bonds are producing a lot more. And if you're not needing the income, then why should you get taxed on it? So where you locate your investments is important depending on how they're going to be taxed. Right? So in your taxable accounts, we want, long-term capital gains at 15%. We want, tax managed fund, index funds, ETFs, low turnover funds, or muni bonds. These produce a very little amount of ordinary taxable income. In your tax deferred accounts, right? That's where you'd want to have, maybe if you're doing some trading, right? You're going to go in and out of things less than a year, right? So it's not going to get taxed at ordinary income. In your bond funds, right? If you don't need the income right now, then have those particular strategies in your tax qualified accounts. So it's not showing up on your tax return. So asset location, we're all familiar with asset allocation, but asset location sometimes doesn't get as much attention. And that can have a significant impact now that bonds are producing some income so that you can minimize that tax liability if you don't need the specific income. So that's asset location. The last thing I just want to highlight is some of the elements of the Secure Act 2.0, right? It was enacted back in 2021, 2020, and there were some significant changes, right? So down here you see they changed the RMD rates that changed in 2023 from 72 to 73. In 2024, some changes were made, but now that some have been deferred. So one thing I want to highlight in all of these changes is Roth catch-up contributions required if prior year wages were greater than $145,000. So that shows that it was going to be enacted in 2024. Actually, IRS changed it, and now it's going to be enacted in 2026. But just be aware, as you start to, in 2026, when you do catch-up contributions, right? So if you're over 50, and right now it's 77,500, if you're doing more contributions, or doing those catch-up contributions, and your income the prior year was $145,000, then automatically your Roth your Roth catch-up contributions are now going to be, or sorry, your catch-up contributions are now going to be Roth. Let me rephrase that so it's clearer. So if in 2026, if you are over 50 and you are making a catch-up contribution, which today is 7,500, and in 2025, your income was over $145,000, those catch-up contributions now have to be Roth catch-up contributions. You don't have the option of saying, hey, I want my catch-up contribution to be pre-tax. If your income is below $145,000, then you have the option, pre-tax or Roth. But once you get over $145,000, now your catch-up contributions are required to go in as Roth contributions. So you may not want to be making Roth, but you're going to have to if your income's over 145, if you're over 50 and making catch-up contributions. So just be aware of that. Also, we talked about this in this next year in 2025. If you are between 60 and 63, you're going to be able to make an additional catch-up contributions. So you can do the 23,500, you do the 7,500, so that's 31,000. On top of that, you can do it almost a little over another $11,000. So you're going to be able to get $42,000 into your qualified accounts, 401ks, 403bs, 401as, if you're age 60 to 63, to really juice your retirement savings. So be aware of that. Try and take advantage of it from a cash flow standpoint if you can, because once you get out of that picture, that age range, those go away. So just be aware of some of these changes that are coming up so that you can be prepared to make sure you're maximizing these benefits. Okay, so we covered a lot. And the question is now, okay, great, that's great. Now what do I do with all this information? So what we want to do is first get organized, figure out what you have, get all your statements, get your past tax returns, conduct a tax analysis. Now, if you work with a CPA, they can do this pretty easily for you. Just schedule some time with them and say, hey, what do you think project my taxes for 2024? They're going to ask you, hey, what is your current income? Has it changed any? Do you have any capital gains that we need to recognize? Any other income, any properties that you bought? Just really give a summary of what you've got. You can establish an income. Hey, here's what I think my income is going to be, or what my income needs are going to be, so I can plan for what my income is going to be at the end of 2024. Then you can implement that plan in terms of what are the tax implications. How now can I be a little more tax efficient, whether it's Roth conversions, HSA contributions, 401k contributions, backdoor Roth IRAs, all of these things that you can now do to minimize the tax liability before December 31st, 2024. And then do that every single year moving on. The other thing that we would recommend is we're happy to do an initial consultation with anyone. We may or may not be a good fit for you, but we find that everyone gets value out of meeting with us. We'll talk about your specific situation. You can bring your statements, your documents, your tax returns. We'll talk through what we are seeing and give you some specific recommendations about what we would have you do. There's no cost for that. There's no sales, no obligations. It's just really an opportunity for you to get the information applied to your unique situation. And then last, we have a number of resources, right? So remaining important tax deadlines for 2024. We've got that checklist. We have a 2024 year-end tax planning guide. We also have 10 income and estate tax planning strategies for 2024. So all you have to do is just email us, put something in the chat. Hey, I'd like to get this resource or that resource. Just let us know. We're happy to share these resources with you so that you can make the best financial decisions for you. Taxes are a big part of what we spend or are required to spend of our resources. So it's an important element for us to be efficient, right? We're not trying to avoid our taxes. We're not trying to, do tax evasion, but there are strategies that we can employ to be more tax efficient with what we are paying and take advantage of these incentives that the code has put out there for us to have more retirement savings or be more tax efficient to lower our tax bill. We want to make sure we take advantage of those. And as you look at your taxes, make sure it's part of an overall financial plan So you know, how much money do I need? How much money do I need to be saving? How should my investments be allocated? Do I need additional insurance, right? What kind of estate planning do I need? Do I have some estate planning strategies that I can employ if I want to start transferring assets to the next generation? There's a lot that goes into it. It can be sometimes be overwhelming. So please take us up on our initial consultation. Also, email us if you have any specific questions. Hey, you mentioned this, or you said this. What does that mean, or how does that apply specifically to me? We're happy to answer those questions so that you have the information to make the best decisions for you. With that, we thank you for joining us today. Please stay on our list. We do monthly webinars so that we can provide educational information for you so you can make the best decisions to have the financial outcomes that you desire so you have the greatest impact on the people and causes you care about most. Thanks for joining us.